This video is a warning to all homebuyers and potential homebuyers because I'm starting to see some realtors and lenders do some not so good things, and I want you to be aware of it. Just yesterday, I was in the sauna at the gym, and about 5 feet away from me, there was a guy, I have to assume he's either a realtor or a mortgage lender, who picks up the phone and puts it on speaker. And he's speaking to somebody who I have to assume is his client, and he's telling his client, first, what is a 2-1 buy down, and he's trying to tell his client that this is the right option for them. A 2-1 buy down is essentially a way for the seller to pay down some of your mortgage for the short term. That way you can go and afford the monthly payments for the short term. So the way it works is, let's assume that you want to go out and buy a home, and currently the mortgage rates are 7.5%. Well, the 2-1 buy down means that this year, instead of paying 7.5%, you only have to pay 5.5%. Next year, you pay 6.5%, and then the year after that, you pay 7.5% because the seller is helping buy down your mortgage for the first couple of years. That way you can ease into the mortgage. And what this person is saying, who I'm going to assume is a realtor or a lender, is that essentially that this 2-1 buy down is a great option for you because nobody can afford to pay a 7.5 mortgage today. So you can take this 2-1 buy down, get a lower mortgage payment that you can afford right now. And then next year, when interest rates drop, he said, when interest rates drop, you will be able to refinance and get a lower mortgage payments, and you won't have any issues then. Now, I want you to understand what just happened. He's telling his client to take this 2-1 buy down because his client cannot afford the current mortgage rate. They cannot afford the mortgage payment at 7.5%. So instead of paying the 7.5% today, they want the seller to pay a little bit of the mortgage this year, a little bit less next year, and then in 2 years, you'd have to pay the full 7.5%. But you won't have to worry about paying the 7.5% because you're just gonna be able to refinance in a year or two, and you'll be able to get a lower mortgage rate. But there's two very big assumptions made right here. Number one is that mortgage rates will fall, and number two is that you're going to be able to refinance. Let's start by talking about mortgage rates falling. How do you know that mortgage rates are going to fall? Now, I know I've talked about this before, but if you look at the National Association of Realtors or the Mortgage Bankers Association, both of them have put out statements saying that mortgage rates were going to fall by the end of 2023. It is in their best interest to say that mortgage rates will fall because that keeps spirits high for lenders and realtors, because that keeps them wanting to sell. Remember, lenders and realtors make money when you sign the paperwork. And I'm telling you this from experience because I am a licensed realtor. I don't operate as a licensed realtor today, but I still have my license. So they get paid based off of you signing the paperwork, not based off of you making the monthly payments later on. Now, I'm not saying all lenders and realtors are bad, but you have to understand the way it works. So there's no guarantee that mortgage rates will fall. Also considering the fact that the Federal Reserve Bank came out this week, and they said, we don't expect to cut interest rates anytime soon. In fact, they're expecting to raise interest rates again before the year ends. So now when you're saying that mortgage rates are gonna fall next year, based off of what? But let's assume now that we can go with this example. Mortgage rates fall next year. There's a second major assumption you just made, that you have to be able to refinance. That assumes that you can refinance. And that assumes that you're also gonna have enough equity in the home to refinance, and that paying the refinancing fees will be worth it. Now, you gotta remember, what's going on today? Housing is less affordable. When housing is less affordable, what happens? People put less money down as a down payment. So now if you go out and buy a home with a 3% down payment on a conventional home, or 3.5% down payment on an FHA home, or you find one of those great exemptions so you can pay a 1% down payment or maybe even a 0% down payment, that means you don't have much skin in the game. So now let's play the same scenario out. Let's assume now that home prices continue to struggle, and maybe we see, I don't know, a 5% reduction in home prices, which really isn't that much considering home prices have gone up so significantly over the last couple of years. If home prices drop by just 5% and you wanted to refinance in a year or 18 months, you would be underwater and you would have to bring cash to the table. So now if you're underwater and you have to bring cash to the table, that means you might not be able to refinance if you don't have that cash. And if you had the cash, maybe you would have been able to make the mortgage payments as it is, because that also means that in 1 year, your mortgage payments are going to rise. In 2 years, your mortgage payments are going to rise even more. So if you have all the stars align and you can take this 2-1 buy down, and next year you can refinance, you pay the refinancing fees, and get a much lower mortgage rate, and you have more equity in your home because home prices rise, great. But that's making a huge assumption. Let's make an assumption that number one, mortgage rates will fall, and number two, that home prices will continue to stay high and maybe even go higher. If both of those assumptions are not met, that means you are going to be left with the bag. That means you're going to be left with higher mortgage payments than you have today. That means you're going to be left with higher payments that you were expecting to make. So now, if you are stuck now with a mortgage that you're struggling to afford because you can't afford the mortgage today, because you would think that a lender would not qualify you for a mortgage that you shouldn't have, but lenders are in the business of making money. How do they make money? By getting you to take out loans. So if you now get a mortgage that you can't afford, and inflation is still around, because guess what? The prices of things are still rising quickly. We haven't hit 2% inflation yet. That means unless you get a big raise next year, you're going to be in a bigger financial hole next year because the cost of living is rising and your mortgage payments are rising. And chances are your income will not be rising fast enough to keep up with the rising cost of living. And then the year after that, well, your mortgage payments are going to rise again. So let's start to think about this. You are taking on a whole bunch of risk if you want to take this home because you cannot afford the mortgage payment, and you take this 2-1 buy down. You take the 2-1 buy down because your realtor says it's a good idea. The lender says it's a good idea. Yeah, we'll get you into your dream home. Yeah, let's get you into this home right now. You don't have to worry about making all these huge payments today. You can worry about it next year, the year after that, when you can refinance. Home prices are going to be higher. You're going to have more equity in your home. We have heard this before. And the time that we heard this before was leading up to the 2008 crash. Back then, it was adjustable rate mortgages. Now, we still have adjustable rate mortgages today, but they're a little bit less attractive now. Now, you're seeing the 2-1 buy down start to rise in popularity. Why are they rising in popularity? Because mortgage rates are getting more expensive. Why are mortgage rates getting more expensive? Number one, because the Federal Reserve Bank has been raising mortgage rates. And number two, it has to do with treasury yields. I don't want to get into all that right now, but this is where now your job, if you're thinking about buying a home, is to be a little bit financially smarter. Do not go out and stretch yourself so thin to go out and buy a home, because if you do, you go out and buy a home that you cannot afford, you could be the one that's holding the bag. Because at the end of the day, it is your responsibility to make the mortgage payments. It is your responsibility to continue paying the bills. It is not your lender's job. It is not the realtor's job. Now, again, not all realtors and lenders are bad, but they are incentivized to sell you a home. Now, some of them will look out for your best interest, but others will not. And this is where your financial education is so important, because if you just trust a banker or a realtor to look out for your best financial situation, you are asking an insurance salesperson how much insurance you should get. And if you ask an insurance salesperson how much insurance you should buy, the answer will always be more. And this is where, again, this financial education, I was in the sauna. I was already hot. When I was hearing this conversation, my blood started to boil. I could not handle listening to this conversation. I was heating up listening to it. I had to leave the sauna because I could not take it. This is seriously dangerous information, because if people start taking on these 2-1 mortgages, what's going to happen if home prices fall? Or what's going to happen if mortgage rates don't fall? And this is where now you are the one that's taking on all the risk. Sure, maybe the seller will be able to give you this concession. Why do they want to give you this concession? Because they want to sell their home. Everybody wants to sell their home if they're in the market. If they have that listing, they want to sell their home, and they're willing to give more incentives now than before because there's less buyers out there. But this is where, again, it is your job to really build that financial education. If you want some resources on how to start building that financial education, we have a free ebook at Briefs Media. It's free. It walks you through now the basics of how do you build a wealthy mindset, to how do you start investing, to different ways that you can invest your money, to how can you earn more money and protect your money. This ebook is free. I got that link for you down in the description below, where you can go to briefs.co/ebook. But for those of you who are in the market to buy a home, please be smart. Please understand what's going on, and do not stretch yourself too thin, because your home, while a lot of people like to call it an investment, it is a money pit until you sell your home, and you do not want to sacrifice your ability to invest your money just so you can have this dream home. You're buying your home to make memories. You're not buying the home that you live in to make money. So do not stretch yourself too thin to buy a home. I know owning a home is a big deal. Nothing wrong with owning a home. Just make sure you can buy a home that you can afford, and no real estate market stays in the same place forever. This is what I always tell real estate investors who are talking about, oh my God, these deals don't make sense with these mortgage rates. I'm going to be not making any money. You're going to lose money every month. Sure, but you got to remember, no real estate market stays the same forever. You have to be patient. You have to be patient as an investor, and if you want to buy things, you have to be patient as a buyer as well. And this is where really, this is absolutely crazy. So please be careful out there if you're thinking about buying a home.